For a brief moment, it crossed $90, a level that once sounded like fantasy. Screens lit up green, charts went vertical, and the narrative was simple. Silver had arrived. And then, without warning, it fell. Not weeks later, not slowly, but almost immediately. That single move turned confidence into confusion. People who chased the breakout froze. Long-term believers started questioning timing. And the same market that celebrated history just hours earlier began asking a very uncomfortable question. What just happened? To understand this, you have to forget the idea that markets move because of news. Markets move because of positioning. And silver, at $90, was dangerously positioned. The rally that took silver there was not random. It was built on months of pressure. Inflation anxiety never fully left the system. Governments continued to spend far beyond revenue. Confidence in fiat currencies quietly eroded. At the same time, industrial demand for silver remained strong, locked in by technology, energy transition, and infrastructure needs. That combination created a powerful foundation. But foundations don't control short-term price action. Crowds do. As silver climbed, it triggered a series of technical breakouts. Each breakout pulled in a new wave of buyers. First came long-term investors, then momentum traders, then leveraged speculators. Finally, late retail buyers who saw only one thing: price going up. By the time silver touched $90, the trade was crowded. Crowded trades are fragile. At that level, something inevitable happened. Large players began taking profits, not because they believed silver was finished, but because risk had become asymmetric. When price accelerates too fast, downside risk grows faster than upside reward. This selling was not emotional, it was calculated. But silver is not forgiving. Once selling began, the structure of the market amplified it. Stop losses triggered. Leveraged positions unwound. Algorithms reacted to volatility. What looked like panic was actually mechanics. Silver didn't collapse because the story failed. It pulled back because the trade became one-sided. Another factor quietly added pressure. The US dollar found temporary strength. Even small dollar moves can hit precious metals hard, and silver reacts more violently than gold. That brief dollar bounce was enough to tip the balance. And just like that, the market changed tone. This is where perception becomes dangerous. To someone watching price alone, it feels like betrayal. To someone who understands silver, it feels familiar. Silver has always behaved this way. It overshoots, it corrects, it tests conviction. Every major silver bull market in history was filled with moves like this. The difference is timing. $90 wasn't just a price, it was psychological. It represented confirmation for believers and fear for late buyers. That emotional clash is where volatility is born. So the drop itself isn't the story. The story is what it revealed. It revealed leverage. It revealed crowding. It revealed how quickly confidence can turn into doubt. But it did not reveal a broken market. And that distinction matters. Because real trend reversals look very different. They come with collapsing demand, changing policy, or structural shifts. None of that happened here. What happened was far simpler and far more common. The market needed to breathe, and that breath came violently. The real question now isn't why silver dropped after touching $90. The real question is what silver does after that drop, because that's where trends are confirmed, or destroyed. When silver pulled back from $90, the most important signal wasn't the red candles, it was the behavior underneath them. Markets speak through structure, not emotion, and structurally, this move does not resemble a collapse. True breakdowns are disorderly, liquidity vanishes, volatility becomes chaotic, correlations break. That's not what we're seeing. What we're seeing is controlled selling. That tells us something critical. The sellers here are not abandoning silver, they're managing exposure. Institutional investors don't exit all at once. They scale. They reduce risk when volatility spikes. They wait for better conditions. That process creates pullbacks that feel dramatic but are actually disciplined. Another important clue lies in short interest. When markets truly top, aggressive short selling appears. So far, that conviction is missing. Skepticism exists, but not confidence in collapse. Skepticism is fuel. Now zoom out further. Silver exists inside a macro environment that remains fragile. Global debt has not been resolved. Fiscal discipline remains absent. Growth is slowing while inflation risks linger beneath the surface. This environment supports real assets. Even if inflation data cools temporarily, the structural drivers remain. Currency debasement is not reversed overnight. Industrial demand does not disappear because of a pullback. Silver's dual identity makes this especially important. As a monetary metal, it responds to trust. As an industrial metal, it responds to necessity. Industries don't speculate, they consume. That creates a demand floor. Above that floor sits investment demand, the most volatile layer of the market. That layer expands and contracts rapidly. Right now, it's contracting. That's not weakness, that's normalization. Another factor at work is leverage cleansing. Silver futures markets are heavily leveraged. Pullbacks flush out excess leverage. That makes the next move more sustainable. Without corrections, trends die explosively. With corrections, they extend. Sentiment now sits in an uncomfortable zone. Optimism has cooled. Fear hasn't fully taken over. This middle ground is where markets often prepare for their next phase. The biggest mistake investors make at moments like this is demanding certainty. Markets never provide it. They provide probability. So far, probabilities suggest adjustment, not failure. Support levels remain intact. Macro drivers remain unresolved. Demand remains present. Silver is not telling us the rally was wrong. It's telling us it was fast. And fast moves always demand payment. That payment comes in the form of volatility. The people who suffer most are those who enter late and expect immediate confirmation. The people who benefit are those who understand cycles. Which brings us to the final question. What happens next? From here, silver has multiple paths, and none of them require panic. The market can consolidate, it can retrace further, or it can surprise to the upside. All three are valid. All three are normal. Consolidation is the quiet outcome. Price moves sideways. Volatility compresses. Attention fades. This is where strong hands accumulate while weak hands lose interest. Deeper retracement feels painful but does not automatically signal failure. Silver has historically retraced large portions of rallies before continuing higher. Pain is not proof of a broken trend. Immediate continuation is possible, but it requires new catalysts. It's the least predictable path, and the one most people emotionally attach to. What matters more than direction is behavior. Does selling pressure diminish? Does buying return at key levels? Does volatility begin to contract? Those signals reveal intent. Silver's drop after touching $90 is not a verdict. It's a test of patience, a test of discipline, a test of understanding. Markets reward those who respect volatility, not those who fight it. Silver remains one of the most misunderstood assets in the world because it refuses to be comfortable. It demands perspective. This pullback does not end the story. It opens the next chapter. And in markets, the next chapter is often written when confidence is shaken and clarity is scarce. Silver has entered that moment. What happens next will not be decided by emotion. It will be decided by structure. And structure so far is still standing.